Good morning, Bitcoiners. Hello, and welcome back to another edition of your Bitcoin Economic Calendar, where we cover the news you need to know for the week ahead in Bitcoin. Today is Monday, March 8th, and this upcoming week is all about stimulus. So the Biden's package got passed by the Senate last week, and it's heading over to his desk for final signature and deployment. With that, we're going to be looking at how that's going to impact Bitcoin and some more of macro dynamics in US banks. We're seeing banks in Germany already starting to offer negative interest rates for their savings clients, and we're going to take a look at whether that is a likely future that could follow suit in the US and why. So, lots to cover today. Onwards to our analysis. So starting as we usually do with Bitcoin, we see that last week provided some very interesting price action, with Bitcoin recovering quite a bit, up 12.66% for the week, closing at 50,967, above that very all-important $50,000 level. Now, there are several macro trends that we will get into, namely how this recently approved stimulus will affect or impact the Bitcoin markets when it hits the streets, and what is happening in the US Treasury markets. First, let's do some stimulus math and calculate how this could impact Bitcoin. Now, to set the stage, we wanted to share that the savings rate for the US consumer for the month of January was 20.5%. Now, this is incredibly high. For context, I'm popping it up in the back of my screen right now. The January reading is not on this chart just yet, but it's at 20.5%. So right around these levels, up or above June 2020. But the important thing to see here is that as you can see, historically, this ratio or this percentage trades below 10%. So just wanted to highlight that stimulus is about to hit the streets when US savings rates are at almost all-time highs. That's very meaningful because the US consumer essentially is sitting on a relatively strong balance sheet that is about to get stronger thanks to these new round of stimulus checks. Now, let's do a little bit of math and calculate what this impact could look like for Bitcoin. So the last round of stimulus went out to 159 million people. So that was people that received checks. Over $267 billion were distributed during that last stimulus effort. This works out to about an average of $1,679 per person. You can follow this math in a more detailed format in our blog. Now, while the criteria to qualify for this round of stimulus seems to be a little bit different, the overall amount to be distributed in the overall package is significantly higher than Trump's previous package. So before we keep digging into the math, let's take a look at what happened to Bitcoin since the first stimulus check that was issued on April 29th, 2020. So I'm just going to do that right here and set up a ruler from April 29th week, the closing of this week, to the closing of last week. So as you can see here from the graph, it was essentially, it's been almost a year since the first round of stimulus was issued, April last year. And Bitcoin is up quite significantly since. So we can see here that Bitcoin's up almost 500% since the last round of stimulus was issued. So to keep digging into the math, let's do some assumptions here and let's put some numbers to calculate what this could look like. So with stimulus, once it hits the streets, inflation expectations are likely to follow suit. And as well as inflation expectations, with that will come a potential desire to hedge that future inflation. So if we were to assume that only 5% of stimulus check recipients will put at least $200 of their stimulus proceeds into the Bitcoin and crypto markets, we get that represents an influx of over $1.5 billion. The exact number is $1.6 billion. Mind you, 5% of 159 billion, it's roughly around 8 million people, $200 per person, that works out to about $1.6 billion. To put things in perspective or to frame this amount in more relative or recent context, that is more than the amount that Tesla recently purchased for its balance sheet. Tesla just bought $1.5 billion. So Now, these are assumptions, so if you can play around with these numbers, these percentages, and these amounts, you can get to much, much larger amounts as far as the end impact to Bitcoin. So interesting to take a look, and we'll definitely keep our eye on price action as stimulus continues to, news about stimulus continues to hit, and the checks are actually delivered to the recipients. Moving over to the S&P 500, last week saw some very interesting activity in the Treasury markets, yet equities were able to shake off a rising yield curve and a rising dollar and rallied higher. So as we can see, the S&P 500 was higher last week by 0.81%, closing at 3,842 points. The Dow Jones Industrial actually made a almost a new all-time high of its own, and the NASDAQ index did itself make a new all-time high of its own. So very interesting to see that. Going back just to pop open the yield curve, you can see that it's actually quite dramatically higher. For the week, it was actually up 6.44% for the week, which is really a remarkable increase in a market like the Treasuries, which is a $21 trillion market. So definitely something to keep an eye on, and it is affecting market dynamics elsewhere. So we've been talking about this at length, and we'll continue to monitor this as it unravels and continues to impact markets. So interestingly, as we said, most indices in the U.S. last week had relatively strong performance during last week's period, and basically during the last few weeks there have been signs in the market that investors are becoming interested in value and industrial stocks. So this can be seen in the performance of stocks like ExxonMobil. So we'll pop up Exxon here. Remarkable week last week, up 12.7%. See stocks like U.S. Steel up 9.27% last week, significantly higher for the recent period. American Airlines, another company that had essentially a relatively good week last week, and it's off to a good start again this week. So if you look at commodities, for example, let's take a look at oil. Oil was up 7.69% last week. If we look at copper, copper again was had quite a good week, and it's been on a tear. If we take a look at that, and if we look at aluminum, also on a tear. So these are signs, essentially, as we were mentioning, that investors are becoming more interested in value stocks, industrial stocks, and commodities. Now, this is healthy for the markets, as until recently, the rally had been most beneficial for technology companies and financial companies. And while some market observers refer to what is happening as the rally taking a breather, there are reasons to believe that what is happening is in fact quite the opposite. And rather than pausing, the market is essentially broadening out its rally and gaining strength for another leg up. Here is some of the articles that we're referencing to in the back, this is a recent one by Bloomberg that says Wall Street rally pauses as big tech loses steam. So this is just one of those articles that we're referencing to, which some analysts are saying, is the rally losing steam. So just to get into this a little bit more, yes, technology companies and growth companies have been underperforming in the last few weeks relative to industrials and commodities. But this phenomenon is also consistent with a broadening rally and reflecting the dynamics that are at play right now in the Treasury markets, where the yields are rising. Rising yields mean that investors are pricing in an economic recovery, inflation, and the fact that the Fed will have to act to cool down the economy from getting too hot. All of these factors are positive for companies and their earnings. What we're seeing right now in the markets is a reflection of how companies are valued and priced by investors and analysts. I'll explain. Rising rates tend to affect companies that have higher rates of growth, more so than they affect mature companies. Why? Because the growth companies have to discount more of their future earnings at a higher interest rate. So when more of your earnings are essentially priced from the future and you have to bring them back in and you're discounting them at a higher rate, it will affect your value today more so than if you just have, earnings that are not growing or projected out to be growing as fast and you're discounting them by the same rate. Because the higher the amounts you have to bring in discount, the higher the impact it will be of rising treasuries. So as we can see, this affects companies that have future growth more so than companies that are already mature and have more stable growth into the future, into the years. So interesting dynamic to keep in mind there, as we're seeing the rally essentially broadening from these high growth, high multiple stocks into more of the value industrial equities. It's important to stay focused in the big picture, because if you don't, it's very easy to get distracted with headlines such as growth companies are being hurt or growth companies are not going to rally anymore. And what we're seeing at play in the markets today could be considered textbook, and expectations that rising rates signal that the economy at large and the companies participating in it will do very well during the next part of the cycle. Again, so important to keep our eyes on the big picture, and we'll dive more into this as again, we continue covering treasuries and how they may impact equities going forward. Moving over to gold, gold continues to underperform. Although we had rising treasury yields and a rising dollar last week, the prospect of passing fiscal stimulus package in the U.S. Was able to drive most equity and commodity markets higher, but not gold. Gold had a significantly down week last week, giving up 1.96%, closing at $1,698 per ounce, well below that very important level of $1,700 per ounce. Given that there are growing expectations of a strong recovery, investors may be looking to divest away from gold and into asset classes that stand to run for a bit faster and a bit farther for the next 6 to 12 months. So again, continue to see relative underperformance of gold. Likely this pattern is to maintain or keep going given the signals that we're seeing in the market. Moving over to the DeFi index, we see that a lot of drama and exploits in DeFi land were not enough to slow down the FTX DeFi index, and were not enough to keep it down this week. It actually closed the week up 21.31%, and it got closer to its previous all-time high than both Bitcoin and Ethereum. If we take a look here, we see that Bitcoin came noticeably farther away from its all-time high. Similar with Ethereum, we see DeFi basically almost making up all the losses from last week and closing very, very near its previous all-time high. This tends to be considered a sign of relative strength, with basically an indicator of the sector's resilience within the rest of its peers in the market. Now, having said that, DeFi continues to show that it can be a high-stakes game, with some interesting headlines coming in through the weekend. One of them being this rug pull from a project called Meerkat, which was basically suffered an $83 million or $31 million exploit, and basically lost a lot of money for the project itself and some of the participants. In addition to that, now this news itself did not grab too many headlines because again, it's a project that is on Binance Smart Chain and perhaps not considered one of the blue chips in this space. However, there is some drama and activity on that side of the industry, with the headline that we see here now, which is there were some issues apparently between the merger, or in the merger between Yearn and Cover Protocol. So Yearn is one of these DeFi blue chips that many people follow very closely, and it's basically interesting to see that there's still issues, or I guess plans go sideways in both the blue chips and some of the newer parts of DeFi. So all that is interesting, because what that says is that although risky, the price action continues to speak for itself in that investors remain interested in this side of crypto. Another part of the industry that is gaining a lot of attention within the crypto industry is the NFT world. We'll be diving more into that in future issues of the Economic Calendar. And if you guys have any questions or anything in particular you'd like to cover about NFTs or DeFi, go ahead and leave some comments below. I'd be happy to answer them and essentially start digging into some of your questions for the next issues. Moving over to our Bitcoin mining difficulty commentary, we see that there was a new adjustment, came in last Friday and brought difficulty down a touch, down 1.34% at 21.44 terahashes. Now, taking a quick look at the mempool, as we can see from the graph behind me, The mempool is still quite bloated relative to historical levels, but transactions can still be confirmed in an orderly fashion if you pay enough. So keep an eye out on the transaction size. This website behind you, mempool.space, actually has some really good estimators to essentially let you peek at what your transaction fees would be call it next block, next 2 blocks, next 3 blocks. So it's good for planning purposes if that's helpful for you. Now, as always, we leave you with what is ahead for the week, and a lot to unpack in this issue. So I'll try to make it as clear, as concise as I can. I guess to get into it. So to prop up the Treasury markets and to keep yields low during the pandemic, the Federal Reserve started allowing banks to accumulate Treasury bonds without counting towards their supplemental leverage ratio. This was done to encourage banks to make purchases of treasuries as the deposits in their balance sheets grew thanks to the stimulus checks. By creating this exemption, the bank's balance sheets would be less strained as a result of the new deposits, since they could buy treasury notes as their savings balances grew and their SLRs were not affected. A bank's supplemental leverage ratio is used to calculate how much equity capital they must keep relative to their leverage exposure. This exemption is due to expire on March 31st, so at the end of this month. And the Fed has not provided any guidance on whether this would be extended or not. If this exemption is not extended, banks will need to go to the market to sell some of the treasury notes they've been accumulating, which will drive yields higher. We're already starting to see some of that with banks participating less and less in the treasury yield auctions as the end of the month draws near. This is basically them saying we're not necessarily dying to run and accumulate more treasuries if this is going to start counting towards our SLR. So, as was discussed by Credit Suisse acclaimed strategist Zoltan Pozsar in his recent Bloomberg Outlaws podcast, which I strongly recommend. This is very important because banks are about to potentially receive trillions of dollars in new savings deposits from the stimulus checks they're about to hit the street, and their balance sheets are constrained. Said differently, they have nowhere to put the new deposits to earn a positive return and have that be accretive to their overall business. As an example, there are already banks in the US on a no-names basis that are telling their institutional clients that they have to pay fees to hold cash in excess of those that they held in December 2020. As Mr. Pozsar further describes in the podcast, once the stimulus hits the streets, banks will likely try to push clients to money market accounts instead of savings. But there's also a structural limitation to that money market account capacity in the repo markets, where banks can only place $30 billion per counterparty given some existing restrictions. What does this mean? It means that the Fed is going to have to get creative to allow banks to take in the new deposits. Depending, or perhaps regardless of what the Fed does, the US might find itself in similar shoes as Germany, where banks have started telling large depositors that they must pay the bank a 0.5% annual rate to hold large deposits with them. All of this could lead to some unexpected side effects in the overall economy and could continue driving people in the US to explore options like Bitcoin or stablecoin savings accounts like Ledens, where they can earn much better rates than with their existing options. Lastly, before we close, to touch on the perpetual futures funding rates for Bitcoin, these are actually substantially lower than their 30-day averages, 30-day moving averages, which tends to be a healthy sign for the market going into the next week. And in addition, in open interest in the Deribit contracts for Bitcoin, we're seeing some interesting open interest in the $72,000 strike for the March 26th expiration. So, as always, if you don't yet have a Ledin account, I welcome you to check out Ledin.io and learn how you can start earning 6% on your Bitcoin and 12.5% on your USDC. If you like this show, if you learned something, I welcome you to subscribe, share it, and leave any comments, or if you have any questions or comments, please leave them in the bottom. We'll get them addressed next week, and we'll try to dig into the issues that you're interested in. So thanks again, everybody. Have a wonderful week, and see you next time.